I keep going back into this point because this is the point of stablecoins. You need stablecoins that are fungible with each other and are very liquid. If you develop a stablecoin on your own, it's actually fractionalizing liquidity even further and making it more and more difficult to scale.
Welcome to another compelling episode of World Ledger with Coco Key. This is your gateway to fresh global perspectives and insightful discussions. Whether you're a curious mind, a global citizen, or a lifelong learner, you're in the right place to discover how blockchain innovation is shaping the world beyond your borders. Everything on this podcast is for informational and educational purposes only. It represents personal views and opinions and does not constitute investment or financial advice or recommendations.
Luca, thank you for joining me today. Why don't you tell us about yourself first? I'm curious how you joined this industry and how you come up with M0 idea.
I've been a financial professional for more than 15 years before starting working in crypto. I'm an economist, mathematician by background, was a consultant for financial institutions, went to business school, became an investment banker covering the financial institutions sector. And I was an investor, hedge fund manager, private equity manager in financials. I've known the financial industry deeply from the inside. I've always stayed away from fintech because to me, fintech was an interesting revolution of the front end of finance, but the back end was the same. And then crypto happened and it was the DeFi summer. I started to play with some of those primitives and I realized suddenly that there was someone out there that was really trying to reinvent the way money is created and absorbed me 100%. At the time, there was a big discontinuity in my private life because I was diagnosed with blood cancer the first week of COVID lockdown. The doctors, hopeful that I could survive, took me and my wife, put us in isolation for 7 months in a room while I was undergoing chemotherapy treatment. I spent this time with her studying, starting to publish my research on DeFi with a Substack that became very respected in the space called Dirt Roads. That was first principle basis in DeFi and collaborating with some of the most important projects in DeFi. When I survived and I got out of that room as a very different person, as you can imagine, I was done following the traditional path. I said, this is my life. I want to make a difference. I want to build what I believe matters. I became an entrepreneur and my life has been so much better ever since.
Wow. How is your blood cancer?
Thank God. I always tell this story because I think it's a good story of survival for people that are going through difficulty. Hardship has been an incredible catalyst for change. My life has been so much better ever since. So I'm always happy to tell this story. I was lucky to be diagnosed with a curable form of lymphoma. Blood cancer typically kills you very quick. My disease, Hodgkin's lymphoma, is a curable disease if you survive. My conditions were not great, but I reacted very well to therapy, so I don't even do tests anymore. I'm now as mortal as everyone else.
Your story is definitely inspiring. When you were doing all the research and you decided to become an entrepreneur, why did you decide to do M0? It's still related to financial industry. And how is it different from fintech?
Yes, and it's a very valid question. So fintech and DeFi are very different. The first project I got deeply involved in was called MiCA. MiCA was the first project in DeFi trying to reinvent money from the ground up. I don't know if people are familiar with MiCA, but MiCA was a permissionless protocol where you could pledge a collateral asset, Bitcoin or ETH, and others, originally only ETH, and mint a subset value of that asset in the form of DAI, which was this purely decentralized form of money. Every different issuer was issuing the same money. This money was hyper transparent and over collateralized based on assets that are existing on chain. It was an incredible idea. To me, it was really reinventing money creation. Most people think that money is a payment product. Money is not a payment product. Money has payment functionality, but money is a debt product. Your current account is actually a liability on the books of a bank. Money is a debt form, a debt product. And MiCA was an incredibly successful project. I was one of the people leading this effort to connect traditional lenders to the protocol to get financed in DAI. We had some large banks that were actually financing their loan books in DAI, which was revolutionary. At the same time, I also started to advise some of the largest investors in the space. Many of them were investors in MiCA. And then in 2022, I came to the conclusion for many reasons that although this idea at the center of MiCA was truly revolutionary, decentralized money, the protocol, like many other protocols in crypto, were early day proof of concept that were not done to scale in the hundreds of billions. So we decided to step back, me, my co-founder, and a few others from the MiCA protocol, to restart anew. We started M0 with the same ambition, creating a form of decentralized money with permissionless contracts and decentralized governance that allow many different issuers bring collateral to mint. And now the collateral could be something from in the real world, treasuries, for example. We started M0 in December 2022 or January 2023, awful times in crypto. This was the FTX blow up period. We managed to raise a very large seed round of around $23 million, significantly oversubscribed, led by Pantera and some of the best investors in the space. We spent 2023 building. In 2024, we got preempted by Bain Capital to raise an additional round of $35 million, participated by some of the best market makers in the space, like Galaxy, Wintermute, and others. In the second half of 2024, we launched the infrastructure on the mainnet. The M0 project was live. It's been a very intense couple of years.
What is the limitation of MiCA? Because I do know some of the projects that MiCA work with. For example, one of them is based in Philadelphia, and they did a lending project with the bank. So to me, there is a lot of potential for MiCA protocol. What is the limitation that you see after working there?
The Huntington Valley Bank deal you're referring to was actually structured on the side of the borrower by my co-founder, Greg DePrisco. Greg is the co-founder of M0 and lead architect of M0. We saw the light together. At the same time, we also saw how painful and impossible to scale it was to actually create those type of bespoke deals within MiCA. And by the way, I think the Huntington Valley Bank doesn't have a deal with MiCA anymore. The protocol became a different thing. The limitations were several. The governance of the protocol was very crypto native. The protocol itself was not designed for the real world. It was designed for dealing with crypto native assets. There were a combination of things, management and design. The M0 protocol started with the same intuition of decentralized economy that is the same across the protocol, like DAI. In the M0 ecosystem, every minter issues the same form of money. But then we went way forward from there. What we created is a protocol that is able to generate an asset that is crypto native called M. And this M asset can be integrated by any distribution venue, any integrations downstream in fully programmable way, programming everything from the yield to the whitelisting, blacklisting, compliance, and many other things. Ultimately, we are reinventing banking. Modern banking works in two tiers. There is a commercial bank at the center and the central bank at the top, many commercial banks. Every commercial bank is different. You treat them all the same. The money in these accounts is all the same because there is a centralized issuer regulator ensuring centralized liquidity. The M0 concept is very similar. There is a centralized protocol that issues money, which is M0. The asset is M, a wholesale form of money. Many different integrations and applications take that form of money and personalize it for their own needs in their own applications without breaking the fungibility and liquidity across those forms of money. Money is important if it's a network. If money is not a network, it's useless. Money needs to be built, needs to be big. Going back to your prior question, what difference with fintech? Our strong thesis is that in the future, every fintech is going to be built on DeFi. DeFi is going to be the back end of global fintech. Fintechs will not build sleek front ends on top of antiquated banks and just try to connect the pieces. Fintech is going to be a very easily programmable front end that is built on top of the primitives that exist in DeFi. M0 wants to be the leading network on which money is created in crypto. Dollar-backed money for now, but any type of form of money.
So you already get into talking about what M0 is I want to step back to understand more, for example, the difference between M0 and MiCA, because my understanding is MiCA is a DeFi protocol and DAI is an algo-based stablecoin. Does M0 do the same thing, a DeFi protocol or infrastructure player that offer this solution? Whoever wants to issue stablecoin will plug and play, and then you offer treasury service, etc.
It's a combination of the two. First of all, the MiCA that you remember is not the MiCA that exists today, or is very different. MiCA even changed their name. MiCA was a protocol. You could issue DAI by pledging to assets. It was an algorithmic protocol, but it was an exogenously collateralized asset, which is a very important distinction compared to Luna, which is an endogenous collateralized asset. There has been a lot of research on this. I contributed as well. MiCA now is very different, doing things more esoteric. The yield is way higher, becoming more of a high yield product. MiCA is becoming closer to Athena than what it used to be before. M0 is a combination. M0, first of all, is a protocol, but it's also is a way for issuers to plug and play, as you suggest, right? If you have assets that you can pledge to the protocol, you connect to the protocol and you mint the stable coin out of that, and you can personalize it with your own brand. But at the center, there is a protocol, actually two protocols, a governance protocol that is not retail in nature and a protocol. Now, because those collateral assets currently do not exist natively in crypto, like T-bills, there are some tokenizers that are tokenizing wrappers, but we're still far away. We are developing tech also that allow the connection of the assets with the protocol. That is something like Web 2 technology. We think that side of the technology will continuously evolve and will become way more crypto native. And we are developing a lot of tools for DeFi native projects. If I have to summarize, M0 is a protocol, but is also a tech company that is building modules around that protocol for people to connect and play certain roles to facilitate the ecosystem.
Let's talk about some examples. Let's assume Stripe wants to issue stablecoin, which actually they are thinking about, and they bought a company, Bridge, to provide the infrastructure. If they want to issue stablecoin, they agree to use M. Would you be able to help them, and how are you going to help them?
Absolutely. We are friends with the Bridge team since the pre-Stripe era. We could help them in several ways. The simplest way is Stripe could purchase M directly on-chain, permissionless on-chain, and personalize it for themselves. They could add a wrapper around it, the Stripe dollar, and use that in their infrastructure. By doing so, they would still benefit from the yield that this M dollar is distributing, is streaming, and they could do anything they want and they wouldn't break fungibility. This is the most important. I keep going back into this point because this is the point of stablecoins. You need stablecoins that are fungible with each other and are very liquid. If you develop a stablecoin on your own, using the Paxos model, for example, every new stablecoin that comes to play, it's actually fractionalizing liquidity even further and making it more and more difficult to scale. By taking M and wrapping it in your own environment, you're not breaking this fungibility because you can go back to the raw material anytime you want and swap it. So for Stripe to embed the M token into their own stablecoin infrastructure is very easy. Now, there is another level we have prepared for. For regulatory reasons, Stripe say we need to issue the stablecoin ourselves. We need to hold the collateral in our own name because the US wants us to be as money transmitter. Assuming that Stripe comply with the requirements that we have for the M0 protocol, we can say, okay, if you have your collateral in such and such form, if your collateral is stored in a certain way, if your collateral is validated, we will allow you to mint M yourself and distribute it. So you don't only have control over the distribution, but you also have control over the minting without breaking liquidity, which again is the core crux of this. And Stripe, for example, they are very good in creating network outside of crypto. Bridge is providing what the name is saying, which is a bridge between crypto and non-crypto. I'm not really sure if stablecoin design is their core business. So I think for us, it's a great example of a company we could partner with. I think that some large financial players obsessing with the control of the technology stack they have, it's going to take them a couple of years to realize that the value of crypto is composability and interoperability. That's what we're building for. That's what differentiates us from the Circles and the Tethers of this world.
Why do you think a company like Paxos, they will face scalability challenges?
Yeah, I mean, they already have, right? Going back to your mental model, when you're asking, is M0 protocol or is M0 a tech company? For us, M0 is a protocol, and then we have a labs company that is creating tools around it. Paxos is a tech company. They are developing tech for clients who want to bootstrap their stablecoins. They're also offering custody services and issuance as a service for their clients. The problem is that every stablecoin that they issue is different. Every stablecoin requires a different liquidity network. It requires a different integration network. If you issue PayPal dollar, PayPal needs to go around and build its own network. Paradoxically, every time a company building on non-interoperable stack is successful, it makes it more difficult for the next one because liquidity is fragmented further. Interestingly, the project they have launched, Global Dollar or USDG, where there is a consortium of people that issue the same token and share liquidity and yield. It is a Web 0.2 way of what we're doing. We're doing this with code, fully open. Anyone can issue the same token. Anyone can distribute the economics behind it and don't break fungibility. We don't need a consortium with a bunch of paper. We just need code. So 100% they could have built it on the token. Maybe I'm still on time to convince them.
Which chain do you use? I recall you use Ethereum to build out your infrastructure.
Yes, the factory that creates tokens, the governance is on Ethereum mainnet. That's where we are. That's, I think, where we will be most of it. But then the M token is streamed into different ecosystems, right? So we are already on EVM compatible chains, layer 2s, optimistic layer 2s. We will be on Solana at the end of this month. We have a very strong relationship with Wormhole to bridge across other environments. The Noble Dollar that was launched yesterday is having a lot of success over the first 2-3 days. Noble used to be an issuer of assets for the Cosmos ecosystem. Now they built their own dollar called the Noble Dollar, built around this concept of programmable yield. The Noble Dollar, if you go through the documentation by Yelena, who's a friend and CEO of Noble, has been built on M0, powered by M0, is M0 infra up to the distribution point.
Noble is considered your first client.
It's our second client. Our first client is a DeFi protocol. We are actually using an extension of M called Usual M that has certain features to manage around $60 million of their reserves. They are a DeFi protocol with around $1 billion of assets, of which $60 million for now and hopefully growing are on M0 infrastructure. So this idea of being stablecoin platform for builders, for coders, where everything is code, full programmability, full fungibility, you don't break liquidity, everything is done by code for applications has been strong for us. The first 2 integrations are live, but we have a pipeline of 30 to 40 that we're working with.
Do you find it easier to convince DeFi companies or Web2 or traditional companies to adopt your technology? I think it's very easy for Web3 or DeFi companies to get your idea immediately.
Yeah, 100%. You can consider the M token a many-to-one-to-many infrastructure. Many issuers can issue the same token and many distributors can connect to the same token. We spent the first few months of the M0 life pitching to Web2 companies, as you suggest, or like issuers, institutions. It was very difficult because these guys really do not understand. Not because they're not smart, simply because they haven't spent the time. For them, money is something that is already coming ready-made for them from a bank, and they integrate it into payment flows. If you're telling like we are reinventing money issuance, they're like, what are you guys talking about? Money is just a payment flow. We don't understand because they are relying on the commercial bank system. We want to eliminate the commercial banking system. it was very frustrating. When you talk to DeFi protocols, they understand it 100%. And they say, yeah, this is awesome. We control everything. We control the liquidity. We control the functionalities. Everything we code, we integrate permissionlessly. The quality of the contracts is super important. We don't have to sign any piece of paper. We are not waiting for you to send us money in a bank account. The yield streams on a continuous basis through smart contracts. They love it. But I'm optimistic because the bridge acquisition for Stripe brought more attention to the stablecoin space. A lot of people are studying. I think the Web2 companies still need a few years to make mistakes and realize what is really important in stablecoin land and crypto. But I think this future where fintech is connecting with DeFi behind is approaching very fast. There will be a few fintech companies that get it and do the transition, a few crypto young companies that build directly on crypto and grow very fast, and a lot of incumbents that will fade in the process, like always happens in technological shifts.
In the market, there is no lack of stablecoin, for example, Tether, Circle. These two kind of dominating the market at this moment. Another thing that people are a little skeptical, that is the situation Circle broke the buck. When Silicon Valley Bank went down, would you be able to avoid that to happen? What is your solution? Or when you try to sell to your potential clients, how do you explain to them?
Yeah, funny enough, people keep saying stablecoins should be safe and their money should be custodied in traditional banks. And then what broke the back for Circle was a traditional bank who went bankrupt. And if that bank wouldn't have been bailed out for other reasons, USDC would have died. I have a Substack called Dirt Roads, as I mentioned before, that is entirely dedicated to DeFi. I wrote an article on Circle called Squaring the Circle. It was discussing the huge counterparty risk that the holders of USDC were having because of the bank custody. And 2-3 weeks later, Circle blows up. It was around that time that I started to chat with the creator of USDC at Circle, Joao, who was the head of USDC forever. That month, I convinced him to come and join M0 and leave Circle. He left and joined us, which is a great achievement for us. We have an obsessive view on quality of the reserves. That's why we're trying to enforce our opinions on the upcoming regulation in the US. We don't want to have bank in the reserves of a stablecoin. I think it's an unnecessary risk. Stablecoins today can be collateralized entirely by risk-free assets. So the M token is over-collateralized by US short-term treasury assets that are sitting in bankruptcy remote vehicles. There is no way they can go bankrupt unless there is technical fraud of any kind. The obsession with solvency is something at the basis of M0. People know what is backing M at the single investment point every day at any point in time. And this is going to give a lot of confidence to people about the stability of the token itself.
When you say your collateral are deposited in multiple vehicles, what do you mean?
In the M0 setup, in order to mint the M token, you need to provide evidence through a network of validators that you have treasury assets sitting in bankruptcy remote vehicles that have been approved on a network. If I want to mint and I'm an approved minter, I'm not the holder of those tokens or those assets. Those assets are actually sitting in a bankruptcy remote vehicle that is monitored every day by a network of validators. So there is daily on-chain attestations. This is like securitization. You're trading notes, which are liabilities of a securitization structure. And there is a legally approved manager managing the assets on the asset side, and it's separate. On the asset side, where the treasuries are, there is huge development. Now there are firms starting to tokenize assets and create on-chain registries that connect the ownership of the asset, at least partially, to a wallet address. There is innovation there that we are incorporating. The important thing is that we can have full visibility about the underlying assets, and those assets are held in bankruptcy remote vehicles. This is not what happens with our bank accounts. Beyond deposit insurance that varies across countries, we are running the risk of the bank. The bank is technically not taking our money, but actually lending out the balance of our money to others. We just hope that if these banks blow up, someone is going to save them. In crypto, we have the ethos, do not trust, verify. You cannot verify what is backing your bank deposits at any point in time. You just need to trust. It's not a great model.
On-chain attestation is real time, it's on a daily basis, and it's transparent.
Yes, absolutely. It's super transparent. The custody is super transparent. The value is attested on a daily basis by independent validators. And we will improve this continuously. But already, if you go on dashboard.m0.org, you will see at the single ISIN level what instruments are backing the $125 million of TVL that exists in the M0 ecosystem.
How do you make money, or what is your business model? Because this industry, people usually shy about asking how to make money, but I'm very interested. I always ask people, how do you make money and what is your business model?
Jeff Bezos used to joke that Amazon was the most successful and profitable business of all times. This is valid in crypto, like Uniswap. Uniswap is a very valuable project, but Uniswap doesn't make money by definition. They don't have fees. They cannot switch on the fees. That's why they're opening a chain that is actually building additional stuff on top. So capturing value in crypto is not straightforward. MiCA on the other side is making a lot of money. Stablecoin issuance is a very profitable business. We have built in the protocol a monetary policy system. Minters, they need to pay a minting fee to mint. The protocol rebates that fee to earners. In a normal situation, the asset yield is equal to the minting rate, and the minting rate is equal to the earner rate. Everyone earns. The protocol makes zero. The entirety of the asset yield is passed down to the ultimate users. But there can be frictions in the middle. You can have a spread at the minter level. The protocol might decide to keep a spread between the minter rate and the earner rate. Maybe not the entirety of the M token is approved for earning. We built very carefully financial levers across the ecosystem, and the protocol is just a residual claimant of those profits. We started this protocol 4 months ago, and there is $150 million of TVL today and growing. The protocol has already made pure profits around like $1.5 million without even paying attention to it. We were not optimizing to make profits. We have built levers that can create spreads across the ecosystem based on supply and demand dynamics. If you're asking me what we're optimizing now and where we think we will go, I think now we're optimizing for growth. We want the M0 network to be as massive as possible. So we don't want to capture any economic. We want to expand. In the long term, the M0 project, if successful, is going to be a project that intermediates hundreds of billions of dollars with single basis point spread, very thin margins, but pure spreads. There is no people, no infrastructure, no operations. There is no one to manage it. This is pure profits that can be captured by token holders.
You are in a business related to money. Is it regulated? If so, who is your regulator? All the jurisdictions try to regulate this type of business nowadays.
Yeah, it's a very difficult question because we are going from a national financial system to a global permissionless financial system. It's very difficult to say who should regulate what. And this is not only stablecoins, it's crypto in general. The M0 company per se is a tech company. We build infra on chain for people to use. Those that manage customer funds or issue digital money instruments like stablecoins, they are regulated in their own jurisdictions. So the use cases of M0, the market of M0 up to recently was offshore. Like the first issuer on the M0 network is a BVI-based company like Tether. We do not actively engage with the US market at all. This market is big enough, but things are changing. As you know, in the US, the regulatory posture is changing. We are participating in the regulatory discourse. Structurally, it is possible for someone to issue using the M0 protocol in a legal way in the US and access the US market. It is a very difficult question to answer because many regulators could claim jurisdiction and many different players at the same time. This is such a difficult time in history because Up to 10 years ago, we didn't have this global financial system that is hyper-connected and fully permissionless. You can move things around. What I always say to my team members is that we shouldn't optimize necessarily for the current regulatory landscape. Obviously, we shouldn't do anything illegal, but we should also optimize for the quality of what we do. We should be proud to defend what we're doing independently from any regulator, because regulation always catches up. We forget very quickly, but 5 years ago, Bitcoin was the currency of drug dealers, scammers, and money launderers. And now Bitcoin is considered a commodity and you can buy it through ETFs on stock exchanges in the US. Why? Because it's big enough, so distributed. Same for stablecoins. People say, stablecoins, they should be with banks because who is doing KYC AML? Nothing easier than doing KYC AML on the blockchain. You see exactly what happens, exactly where money moves. It's way easier to launder money through cash or bank deposits. I think we should keep building, trying to engage with the regulators in a constructive manner so they can develop regulation that makes sense. The current regulatory environment is made for technology which is old.
What do you think Tether's next move would be? They don't report to anybody and they serve the whole world. They might find it harder to do business, especially when they're cornered by regulators, including in Europe, like MiCA is enforced and the US regulation is coming. What do you think their next move would be?
Tether is a bit different because Tether is an extremely centralized player, so they are a centralized issuer. I don't think Tether cares at all about MiCA. Their market is outside of Europe and is big enough for them to serve. I don't think Tether is going anywhere. I don't think Tether is going to be 70% of the stablecoin market in 5 years. They're going to be dominant of their niche, which is going to be offshore dollar distribution. They're printing so much money. Now it's a problem. They have too much money to invest. If you start having $15 billion of cash profits every year, it's difficult to deploy them. Tether is not going to become a US regulated business. They might be grandfathered in the US to circulate. Tether is very close to the enforcement agencies in the US, paradoxically closer than Circle. They will continue to thrive, but they are serving a very specific use case: trading, perp trading, emerging market transactions. Stablecoins would be the new iteration of bank deposits. If you think the whole bank deposit stack is going to move on stablecoins, Tether is not going to capture 70% of it. Tether is going to capture 10, 20% of it, which is enough for them to run an incredibly profitable company.
I want to get your thought about stablecoins market. The US has sophisticated payment system, financial system infrastructure. In emerging markets, the infrastructure is not there. So the need for stablecoin is tremendous. Which market would be your favorite market or markets?
We are very agnostic. I think you have a point. Emerging markets where technology and payment systems do not work so well are more attractive because they have an immediate benefit with DeFi. But I think the benefit is also in the US. The banking system in the US is not great. I mean, I used to be a financial institutions banker of European origins. The vast regional banking system in the US is not a good one. It's actually quite shaky. Obviously, the emerging markets are going to be dominant. This market is so big that it's very difficult to pick favorites. We are building for builders, build financial applications on top of us. Wherever they want to build, I think there will be pockets of usage everywhere. Even in the US, how many times have you gone to a local branch in the last 10 years? I have been probably twice. I was always very annoyed when I had to go there. But you interact with fintech front ends, and these fintechs will substitute the back end. I think the experience of interacting with crypto wallets, etc., is really going to change in the next 10 years. Users will just interact with their computers and phone. And crypto is going to be 100% an infrastructure play, because even in the US, infrastructure does not work so well. There are low-hanging fruits. Cross-border payments are really awful experience, so you can really improve them easily. But you can improve the whole stack in finance easily. It's really antiquated. We are working remotely. We never even go to the office, and we need to wait 3 days to send an international wire. It's crazy. And there are so many other examples like that.
And what is your take about the US Genius bill? How does it compare with MiCA? Is there any component in MiCA that addresses stablecoin?
I think MiCA is a very bad regulation. I'm European, and I always feel very sad when I see how Europe is strangling new businesses by imposing silly regulation. In MiCA, if you want to be a stablecoin issuer, you have to keep a big chunk of your reserves in locally regulated banks, which is so weird. As we were discussing before, the SVB situation is not great. Also, stablecoins are global. How can you move the reserves depending on where the money is? It's just like the Schrodinger's cat stablecoin, like where are the reserves? You don't know until you need to see it. MiCA has been an awful regulation. It's such a small market, getting smaller and smaller by regulating everything to death. Unfortunately, I'm European. I'm used to it. That's why I don't live in Europe. In the US, the Genius regulation is way better designed. It's still not perfect. Relying on money transmission actually is a very low-touch regulation. It's way more stringent for large issuers. I don't think it's great for Circle. I was asked by some very large investors in crypto to provide my opinions. I also published on Twitter. I would like to see more openness in using bankruptcy remote structures to store reserves instead of forcing people to keep it in regulated banks. Also, I would like to see a carve out for decentralized stablecoins where decentralized stablecoins are compliant to the same standards, if not higher in terms of security, but there is less prescription on the tools. DeFi has new tools. Maybe you don't need a trustee in Delaware. You just need a smart contract with a security system around it. And I would love regulator to look through the implementation and ensure that certain designs comply with regulation in principle, even if the tools are different, which is important for innovation. We'll see. It's in the draft. A lot of people lobbying. There is a lot of silly lobbying. I don't think it's going to go anywhere because it's suicidal. I unfortunately see a few big businesses trying to kill competition by regulation. I think you kill competition by creating great products. So the people doing great products are always going to win. You made the example of Tether. Everybody tried to kill Tether with regulation, but Tether has built a liquidity network in emerging markets that the users absolutely love, and they use it, and they don't care about regulation. I think people should learn. We shouldn't try to protect business, killing competitors with regulation. I think it's bad.
If you want to break into the US market, would you be regulated by Genius bill?
Our tech is on chain. The issuer, if we would have an issuer in the US, the issuer that uses the M0 stack will have to be regulated by the bills, of course.
Would that slow down your business growth because all the issuers have to go through the regulation, the application process and get approvals?
Yes and no. We have a multi-issuer system, so we can keep doing businesses in other places in the meantime. We don't need to start an issuer in the US ourselves. We can partner with someone who already has the licenses to do that.
These are all the questions I have. I would love to stay in touch and keep learning what you are doing and your progress.
Absolutely. Thanks a lot
Thank
for
you.
having me.
Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss out on my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.